So my talk is going to be about a little bit about 2024, the year of the dragon, and more so about the year of the snake, which is this year. Okay, so we'll talk about the year in review, get going here, and this is usually what I talk about every week in the newsletter. These asset classes, commodities mixed up with ETFs, interest rates, and that, and as probably all you know, is Bitcoin had a phenomenal year, but mostly in the latter part of the year because of the Trump, the higher probability of the U.S. Change in the U.S. administration into the incoming Trump administration, and the potential for deregulation helped Bitcoin a lot. Natural gas was about pipelines in the Ukraine. NASDAQ was all about AI. But under all that, we had a spike in market volatility as we were going into the latter part of the year. But for us, precious metals, gold and silver did phenomenally well. But the gold equities, I mean, they did well, and some of them did really well. But on average, using the GDX ETF, they didn't outperform precious. The weaker Chinese economy supported the demand for gold, but led to very mixed returns for industrial commodities that we follow. So with respect to gold, I tend to believe is to follow real rates, the trend for real rates. And so what was gravity defying for gold was when the real rates were actually going up, gold continued to go up. And that was mostly because of central bank buying, which is mostly the Chinese. But then when we had the real rates going down, gold continued to go up, obviously, but the demand changed. Now we had more interest in U.S. investors. And then when we got that, then that would bleed into equities. Demand by central banks does not bleed into equities. But when we see this happening and the U.S. investors getting involved, that bleeds into equity ETFs and blends into equities, and then goes downstream, trickles down to smaller companies. And gold kept going. After U.S. rates were going up again, gold continued to go up because of the uncertainty around the U.S. elections. And towards the latter part of the year, it remained volatile, a bit volatility, but flat. So gold really didn't have any major disruptions on its way up to give us that 20+% return. So as you all know, we have a new U.S. administration, and I think that'll be one of the biggest impacts because the biggest impacts on last year, again, were all the factors that impacted the major economies, the U.S. and China. And so around $15 billion was spent by 11,000 political groups on both sides for that election. But consequentially, not only is the U.S. administration incoming, have the White House, they have the majority of the Senate, House of Representatives, most of the state governors, and they put in the majority of the Supreme Court. And so their ability to pass stuff is much better than it was in the first U.S. administration. And so now I'm just going to go some of the things that the Trump administration wants to do. They would prefer low rates. Whether they get them or not is another thing, but he definitely wants to get rid of the current chairman because he was raising rates here. The question is, with the issue about tariffs, which was not implemented, when they made the last reduction, is slowly bleeding into the dot plot. And so the September dot plot shows you a lot of the governors thought that the US interest rates in 2026 would be down below 3%. That changed in December. So the idea that interest rates may not be going lower, but might actually be flat to going up higher. And this is with the US Federal Reserve Chairman saying the idea or the impact of potential tariffs was not even put into that. But you can see from the implied rates after the September meeting versus the December meeting, would be September was going down to 3%, whereas after December, it was at 4%. So the market is taking it into account. The other thing that they would like is a weak US dollar. But after the election, the US dollar actually went up. It went down after the interest rate cut, which was post-election, but the US dollar's futures have been doing well. But that's not what the incoming US administration would actually like. But most of that's being driven, again, by the potential for tariffs. Tariffs might have an impact on inflation in the States, higher inflation, potentially higher interest rates, and higher US dollar. So as you could see from the election, or prior to the election, October to the end of December last year, the US dollar was up about 7%. So even though those forecasts on the dot plot that I was showing you did not apparently take into account the potential impact for tariffs, everything else is. So let's talk about the tariffs. And so the US trade balance from 1950 to 2024. So the trade balance around here, that's when I moved to the States, was around here. But you can see around $10 billion. This was the first Bush administration. Clinton administration was similar. And then post 9/11, when the commodity supercycle was happening and the US was pushing manufacturing out, focusing on services, we had no problems with low interest rates, but also having cheap goods come from the Chinese. And so then the deficits were getting up to 60 billion. They went back down to around 40 under the Obama administration after the global financial crisis. Trump went up slightly, but then Biden, he got up to almost $100 billion at some points. And that's basically some of what the incoming administration wants to bring down by imposing these tariffs. And so 3 countries represent 45% of total US imports: Mexico, China, Canada. And the major imports include fuel, and a lot of that comes from Alberta. Machinery, China. Electronic goods, China. Vehicles, Mexico, China, and Canada. And so what we've seen is the idea for nearshoring was already coming into play during the Biden administration. But what was actually happening was a lot of the Chinese manufacturers were moving to Mexico. And you could see that, which is weird. I went to Tijuana to go to Hermosillo, to go to a mining conference there. And the amount of Mexican airlines that were landing in Tijuana took me by surprise. And so that nearshoring and the impacts on China with the Biden administration lowered the imports from China, but we had a rise from Mexico. So I think part of the idea with the incoming US administration is to battle Chinese investment in Mexico, so the goods are coming up from Mexico, but they're basically Chinese. And so the impact for us in terms of commodities is the Chinese economy, how it's going to impact the Chinese economy. It's already impacting the Chinese economy in terms of currency, but for us, it's going to be about their demand for commodities because they're the biggest consumer of commodities. And so when Trump was elected, copper went down. The only reason a lot of these things popped back up was the US interest rates were cut right after. But that weakness is problematic, especially for producers. And that generates a lower incentive price to build. So that will make a bigger kick coming up in terms of the copper deficit because less people will build. And so the Canadian deficit with the US is about a fifth of China, and most of that is fuel. So if you take the balance and take out the oil and gas, mostly from Alberta, they actually have a surplus with Canada. The Chinese economy, what we're hoping for is they need more stimulus. That would hopefully bring in more commodity demand. And you can see in terms of the broad budget deficits, in terms of percentage of GDP, they're getting there. But if the US consumer is cut off from the Chinese, they'll have to find other places to go, especially if they impose 100% tariffs on cars, and I think 25% tariffs on everything else. And I think they were looking at almost banning some products. Nearshoring in Mexico, and so nearshoring helped the Mexican peso, but the idea that it might go away with the tariffs has really impacted the economy in Mexico, because that is the big push by the new president, who's also part of the same party, Morena, as AMLO, Andres Manuel Lopez Obrador. Very left-wing, but the nearshoring is very important to them. So if you look at foreign direct investment in China, most of it since 2022 has been people reinvesting in the country that are already there. The problem for them is they're not getting much new money. Most of that is their own problem because of the left-wing policies that they have. Mining especially has been problematic there. But they were trying to reduce permitting for infrastructure, digital infrastructure, deep water oil, and those are the industries that they were promoting in terms of nearshoring. But what we've seen is some companies that build cars mainly to export them into the States from Mexico, if the tariffs exist, they're not going to build the plants in Mexico anymore. They'll build them in the States, which is exactly what the incoming administration wants. So that will impact the Mexican economy. So when I was down at that conference in Hermosillo, you can see some mixed reactions to what was happening in Mexico, not only by the Mexican government that was almost anti-mining, pretty much, with not a ban on open pit mining, but definitely no interest in permitting one. Grassroots exploration is basically dead there. So if you're in Mexico, you got a project, you're probably okay, especially if you're in a good province, a state. But if you're not, nobody's coming in. So that could impact M&A as well. But most of the M&A we've seen has been mixed. So Orla, who have an asset that makes a lot of money, Camino Rojo, are not buying in Mexico. They bought Gold Standard Ventures outside of Mexico, Nevada, and then the most recent one was Musselwhite, a divestment by Newmont. So they are taking the approach, we want to diversify out of Mexico. Others who are currently operating in Mexico have taken advantage of the current situation, potentially, like First Majestic buying Los Gatos and Coeur Mining buying Las Chispas. And these were both in all-share transactions. And I don't know how many others were bidding for those. I mean, the idea with Mexico really helps silver. Because if we're not exploring for it and there's less development of silver assets in Mexico, that silver exploration, potential future production won't be in Mexico, which is the major producer, one of the major producers of silver. So I was in Peru as well, and so a lot of those companies are going back to Peru, which is also has its issues with permitting, which they're trying to get improved. So then we get into critical minerals. So I was at a Red Cloud event last November, and they had somebody who was part of the SAFE group that talks about critical minerals and Canada's part in that. But what they were trying to tell everybody was the Democrat focus was on energy transition, new green technologies, whereas the Republican focus is mostly on national security. So where that overlaps into national security, that's what they'll promote. And so you can see from this is the EV penetration in these states. Red signifies that they're Democratic leaning. So there was only one state that voted Republican that actually has any significant EV penetration or cares about that. So him going against EV is not going to change the people that follow him. But that subsidy that everybody has been looking to get from the parts and that might just be eliminated. And so that's problematic, especially for demand we're talking about in the States. So this is the competitive landscape for clean energy technology. And you can see the baseline is China. Europe, the US, India, Korea have a hard time competing with the Chinese. So the idea is to increase their tariffs so they're less competitive. But if you make them less competitive, the EVs get more expensive, less people will buy them. And if you eliminate the subsidies, less demand. And you could see that they're the biggest in the technology. So if you actually want to grow the technology, you really need to talk to them, but nobody will. And so you see the trade flow. So a lot of it goes to Europe, and through Europe, some of it comes back to the States, or it comes around and goes there. This is what they're going to impose significant tariffs on. And so how will it impact the EV market specifically? It won't have as big of an impact as we might think, because 60% of the EV demand penetration is China and Europe. 15% is the US. It will have an impact, but not as significant as you see, because the growth was never in the US. It was outside the US. The other issue is the US outgoing administration had this $400 billion green bank. So as the administration was coming to its end, they were pushing out as much money as they could before the incoming administration took the keys. So there was a lot of money there to provide for green technologies, which, like I said before, the incoming administration is less interested in. This is just a graphic on showing what some think would be the impacts of removing the investments in green technology on US installed green technology going forward. The blue line would be the case with having that investment. The black histograms would be the case of not having that investment. So one good example is the South Korean companies that were considering a $54 billion investment into EV plants in the US. But if they undo the tax credits, they might not make the investment. So how does that translate to us? Security over energy transition. So things like antimony that the Chinese have banned the export of, that is more important. So Perpetua, which needs about $1.2 billion to build their gold-dominant antimony byproduct, maybe 5% of the life of mine revenue, maybe, is, depending on the price, is antimony. But there's the potential for them to get 100% of the capital required just for that antimony from a US government agency. So this is the world we live in. Deregulation. So a company that did really well is a company I used to cover, Trilogy, which had a permit. Ada had the permit to build the road, the 211-mile road, to get to their project. And then they took it away. And the idea that the Trump administration will bring it back, you know, generated that kind of return after the election. And also the deregulation, obviously, as I talked about, for potentially Bitcoin is what pushed that over 100,000. So deregulation is a big theme. And so lower taxes, so they have those tax cuts that were put in the first U.S. Administration, the Trump administration, which now come up for renewal. So I've got, I mean, it's 100% probable that that will be renewed. But then the potential is that the deficits might get bigger. And if they do, in the end, that would support gold. So, recap. 2024, precious metals equities outperformed industrial metals, but equities did not outperform precious metals on average, if we look at the GDXJ versus gold. Gold was supported by a myriad of demand. So it wasn't central banks only, a lot of retail, Chinese and European, US ETFs, when the interest rate trend was going down. Base metal performance, as I said, was mixed due to weak Chinese economy. That may continue because of the tariffs, but that will just set up things like copper even more, and we'll see more consolidation in the copper market. Like there are rumors out there that even Rio, was it BHP, I think, and no, Rio and Glencore were thinking about getting together. So see a lot of consolidation still being looked at. So some of the things that the incoming administration would like and can push for, even though that they are, if Fed's supposed to be independent, lower interest rates, weak US dollar, help exports, the tariffs to lower their deficits from the hundreds of billions during the Biden administration to something more manageable. But that will impact inflation in the US. China will need a significant stimulus package, but if the US consumer is cut off from the Chinese goods, that will be problematic. In terms of in terms of Mexico, the nearshoring plan that they have that was supposed to build up the economy is at risk. Does that force them to go back to mining? I don't know. Because if you ban those open pits, that's significant foreign direct investment. Like Teck and Agnico have the San Julian project, the base metal project, I think in Zacatecas. Teck paid $500 million for 50% of that project. And if there's a ban on open pit mining, which is not official, that's problematic. Security over transition. China is the benchmark for green technology, low cost, major exporter of the technology, and EVs. The US EV penetration is much less than China and China and Europe. So the demand impact will be less because of the penetration is only 10 to 15% in the US, but it still will be an impact. This funds out there for transition metal projects will be reduced. But security, whatever they consider to be security minerals, that will continue, may accelerate. Deregulation, and so for people in the States, like Liberty Gold here, advanced exploration, trying to develop, this window with the Trump administration might be good. And then finally, higher deficits underpinning positive for gold. All right, great. Thank you very much.